So, this is the continuation of the previous discussion SLFRS 8. We discussed operating segments. SLFRS 8 defines two segments basically, that is operating segments and the reporting segments, reportable segments, and we in the first video took up the discussion of operating segments, and for a particular business activity to be a separate operating segments, there are three conditions or three requirements to be fulfilled. I have given you examples enough. So, we are moving on to discuss the reportable segments and see how reportable segments are identified. Now, in this sequence of identifying segments, what is to be first identified should be the operating segments, from which then you will continue to identify reportable segments, and this sequence should not be mixed up. It is not that we will first identify reportable segments and then we identify operating. No, we will first identify the operating segments, from which then you will continue to identify reportable segments. In short, what do you mean by reportable segments? Now, having identified operating segments, you need to provide and disclose some important financial statistics and data. So, it is not about you preparing a separate set of accounts, separate set of financial statements for operating segments, It is about you providing required and necessary information, financial data, financial statistics for the segments we have identified. So, what information to be disclosed will be discussed in a little while towards the end of our discussions in this video. And to identify reportable segments, we use three quantitative threshold. Quantitative. So, you need to measure, you need to do measurements using some yardsticks, and let us see what these yardsticks are. SLFRS 8 gives us three quantitative threshold. First is the revenue threshold. Second is the profit or loss threshold. And this is bit of a tricky one, and you need to get it right. If not, you will make mistakes at the exam or in a practical scenario. Third is assets threshold, assets. And let me give you a small overview first before we go for the calculations and to see how we do it. If the total assets of a particular operating segment is 10% or about 10% of the entire total assets of the combined assets of the entire segments, that particular operating segment can be considered to be a reportable segment, and then you need not to look at the remaining two criteria. So, it is not like identifying operating segments. For you to identify operating segments, all the three requirements were necessary. But here, for you to identify reportable segments, you need not to look at all the three. If at least one quantitative threshold is fulfilled, so that particular operating segment can be identified to be a reportable segment even without looking at the remaining two quantitative threshold. Profit or loss. The way it reads looks little complicated, but if you get it right, I do not think that will be complicated. If the profit or loss of a particular operating segment is 10% or more of the combined profit of the higher of the total profits of the segments that reported only profits and the the total losses of the segments that reported only losses. So, that's bit of a complicated thing. I mean, the way it is articulated, the way it is read in the standard, that looks bit complicated, but let me give you some illustrations and then you will get it right. So, that particular segment should be considered to be a reportable segment. And a particular segment whose revenue is not 10% or above 10% of the combined revenue of the total segments, then you do not come to a conclusion that particular segment does not become a reportable segment, and then you can continue to apply the second quantitative threshold, that is profit or loss. And say if a particular operating segment does not have a revenue which is 10% or above 10% of the combined revenue of all the segments, and if that particular segment has a profit or loss which is above 10% or 10% or above 10% of the combined profit or loss of the total segments, so that particular segment does become a reportable segment. So, what I am saying is, even if a particular operating segment does not fulfill the first, not that you should conclude that particular segment is not a reportable segment, you need to continue to the second one. Even if the second one is not fulfilled, you need to continue to the third one. And a particular operating segment does not become a reportable segment only if none of these quantitative thresholds will be fulfilled. If at least one quantitative threshold is fulfilled, that particular segment, operating segment, has to become a reportable segment. So, now assets. If the total assets of a particular operating segment is 10% or above 10% of the combined total assets of the total operating segments, so that particular segment also becomes a reportable segment. So, that is how it says, and let me give you a simple example illustrations and let us see how best we can identify the reportable segments, rather reportable segments. So, let me give you a simple example. We will identify the segments. Then we will take revenue quantitative threshold, revenue threshold. Then we will take profit or loss. Then we will take total assets. So, let me say assets. So, these are the segments we have identified to be operating segments A, B, C, D, E, F, G, H, I. Revenue, so all the figures are in 1000, this is 9000, this is 8700, 7600, 7200, this is just 500, just 200, this is 6800, 5700, and this is 6900. Profits and losses. Here the profits are 4600, 4900, this is 3700, and there is a loss of 2100 here, and there is a loss of 1600 here. So, there is a loss of 1900 here. There is a loss of 200 here, and here the loss is 300. Here the profit is 5,800. Assets 10,000. This is 11,500. 10,500 total assets. And this is 9,000. This is 800 assets. This is just 900 assets. This is just 500 assets. And here 8,400, and here it is 9,600 total assets. Now let us take the totals down, and then here let us work out the percentages. Percentage of revenue, percentage of profit or loss, percentage of assets. Right. We will go on adding the total revenues of all the operating segments together. Let us see what the total should be. 9,000 plus 8,700 plus 7,600 plus 7,002 plus 500 plus 200 plus 6,008, 5,007 plus 6,009. 52,600 should be the total revenue of all the segments. The combined revenue of all the segments should be 52,600. Let me do a small quick double check. 9,000 plus 8,700 plus 7,600, 7,200 plus 500 plus 200 plus 6,800 plus 5,700 plus 6,009, 52,600. Now you cannot net off the profits against losses and put the net figure here. That is not what is required by SLFRS. So what it requires is something else. Let me explain what it is. You need to combine, aggregate the profits of the segments that reported only profits and put it separately. Also you need to take the aggregate losses of all the segments that reported only losses. Then you need to isolate A, B, C and I separately because they are the segments that reported only profits, and let me put the total profits down. 4,600 plus 4,900 plus 3,700 plus 5,800, 19,000 should be the total profits of the segments that reported only profits, and let me write it separately down. Then also similarly you need to isolate the segments that reported only losses, and let us take the total losses of the segments that reported only losses. That is D, E, F, G, H, and we will put the total here. 2,100 plus 1,600 plus 1,900 plus 200 plus 300. The other total is 6,100. Let me do a small quick double check, will you? Profits 4,600 plus 4,900 plus 3,700 plus 5,800, it is 19,000. 2,100 plus 1,600 plus 1,900 plus these two 6,100, right. Then similarly you can take the total assets of the segments, combined assets of the segments, operating segments. Let us see, 10,000 plus 11,500 plus 9,000 plus 800 plus 900 plus 500 plus 8,400 plus 9,600 should be 50,700, and let me do a quick double check with you. It has to be 61,200, 61,200. Yep, 61,200, right. Then let me work out the percentages of revenue of each segments we have identified to be operating segments, and let me put the percentages here. So, it is just a matter of dividing the revenue of each segments by the total segments and putting the percentages here, and let us see what will become reportable segments by applying the first criteria, what is the first quantitative threshold, that is 10% revenue threshold. So, 9,000 divided by 52,600 into 100, it is 17%. 8,700 divided by 52,600 into 100, that is 16.5. So, let me make it also, we will make it 16%. 7,600 divided by 52,600 into 100, it is 14%. 7,200 divided by 52,600 into 100, it is 14% once again. $500 divided by 52,600 into 100, it is 0.95. Let me put it to, we will round it off to 1%. 200 divided by 52,600 into 100, just 3%. Let me just put it as a 0, it is so negligible. 6,800 divided by 52,600 into 100, and this is 12.9. So, let us round it off to 13%. 5,007 divided by 52,600 into 100, this is 10.8, we will round it off to 11%. 6,009 divided by 52,600 into 100, this is 13.1, we will round it off to 13%. Now, even without you proceeding to the second quantitative threshold, right by applying the first quantitative threshold, you can identify couple of reportable segments. What are those? What are those? A already becomes a reportable segment, B already becomes a reportable segment, C already becomes a reportable segment, D already becomes a reportable segment, G, or before that, yes, G already becomes a reportable segment, H becomes a reportable segment, I becomes a reportable segment. Now, for the segments whose revenue is either 10% or above 10%, you need not to apply the remaining two quantitative threshold, but since we do it for the learning purpose, let us apply and see whether those segments which have already become reportable segments will further fulfill the remaining two quantitative thresholds as well. But in practice or at the exam, you need not to apply the remaining two quantitative thresholds for the segments which have already fulfilled the first quantitative thresholds. Now, if you read the second quantitative threshold, it says the reported profit or loss is 10% or more of the greater in absolute amount of the combined reported profit of all operating segments that did not report a loss and the combined reported loss of all operating segments that reported a loss. Now, let us see what the rigmarole is. As I said before, you need not to net off the profits against losses and to take the net profit or loss of the segments. No, that is not how it says. As I said before, you need to isolate the segments that reported only profits, also you need to isolate the segments that reported only losses, and then we will take the total profits and the total losses separately. Having taken the profits total and the loss total on absolute terms, what it says is without you netting off the losses against the profit, without you netting off the profits against losses, you need to take the absolute profits of the segments that reported only profits and absolute amounts of losses of the segments that reported only losses, and that is what we have done here. Now, compare the total profits of the segments that made only profits and the total losses of the segments that made only losses. Compare those two and select the higher one. 19,000 is the high. Then what you do is, indiscriminately, irrespective of a particular segment has been at a profit or has been at a loss, all these numerical figures, irrespective of whether they were profits or losses, all these numerical figures will be divided by the higher of these two and see what the percentage is. Now, you need not to ignore losses just because we have taken the total of profits. In case the loss figure was the higher figure, then again you should not ignore the profit figure just because the higher figure was the total loss figure. Now, indiscriminately, irrespective of a particular segment is at a loss or a profit, the numerical figures of the profits and the losses will be declared as a percentage on the total profit or loss, whichever is higher. Then 4,600 divided by 19,000 into 100. So, that is 24%. 4,900 divided by 19,000 into 100. So, this is 26%. 3,700 divided by 19,000, 19%. 2,100 divided by 19,000 into 100, so that is 11%. 1,600 divided by 19,000 into 100, it is 8.4%. 1,900 divided by 19,000 into 100, this is 10%. 200 divided by 19,000 into 100, just 1%. 300 divided by 19,000 into 100, this is 1.5, will round it off to 2%. 5,008 divided by 19,000 into 100, that is 31%. 31%. So, that is quite easy, and let us identify the reportable segments. Anyway, A continues to be a reportable segment, it satisfies the second quantitative threshold as well. B continues to be a reportable segment because it satisfies the second quantitative threshold as well. So is C, so is D, and E continues not to be a reportable segment because it does not satisfy the second quantitative threshold either. F, and that is where you need to pay attention, because F did not satisfy the first quantitative threshold, so it did not become a reportable segment in the first quantitative threshold, but it satisfied the second quantitative threshold. So, F continues, or F also can be considered to be a reportable segment now. G, and that is also an important point to be highlighted, became a reportable segment because its revenue is higher than 10%, it is 13% of the combined revenue. Now, the profit quantitative threshold, it does not satisfy the profit quantitative threshold. So, does it become, I mean, just because it does not have a 10% of the profit or loss of the combined profit or loss, does it say that now segment G otherwise does not become a reportable segment? No. If it becomes a reportable segment once and for all, it continues to be a reportable segment irrespective of whether the remaining quantitative thresholds will be satisfied or not. So, that continues to be a reportable segment, and this is not important, you know, I think that point was clear. And H became a reportable segment, but it does not satisfy the profit quantitative threshold, that is all right. So, H continues to be a reportable segment. I continues to be a reportable segment because it satisfies the second quantitative threshold as well. So, let us go to the third one now. $10,000 divided by 61,200 into 100, 16%. 11,500 divided by 61,200 into 100, this is 19%. 10,500 divided by 61,200 into 100, this is 17%. 9,000 divided by 61,200 into 100, 18%. 800 divided by 61,200 into 100, this is just 1%. 900 divided by 61,200 into 100, this is once again just 1%. 500 divided by 61,002 into 100, and this is just 1% once again. 8,400 divided by 61,002 into 100, this is 14%. 9,006 divided by 61,002 into 100, this is 16%, right. A continues to be a reportable segment, B continues to be a reportable segment, so does C, so does D. E does not complete and satisfy the third quantitative threshold either. So, this E reportable, reportable segment has to be a segment which satisfies at least one of the three. So, E does not satisfy any of the quantitative threshold. So, E does not become a reportable segment. E continues not to be a reportable segment. F just 1%, but that does not matter because F has already become a reportable segment by satisfying the second quantitative threshold. G does not become G has already become a reportable segment by satisfying the first quantitative threshold, but it does not satisfy the remaining two, but it does not matter. H continues to be a reportable segment, it satisfies only 2, that is all right, and you need not to, particular operating segment need not to satisfy all the quantitative threshold. I continues to be a reportable segment. Now, let us identify the reportable segment except for one operating segment, everything else becomes reportable segments by satisfying some quantitative threshold or rather. Now, A is a reportable segment, B is a reportable segment, C is a reportable segment, D is a reportable segment, E is not a reportable segment. So, let me remove this circle, and F is a reportable segment, G is a reportable segment, H and I are reportable segments. So, these are the segments that are worth being reported about separately, but it is not all about, it is not about you preparing separate set of accounts for these segments we have identified to be reportable segments. It is about you presenting and disclosing the necessary and required financial statistics and data in the financial statement. That is what is required. So, once again, as I said before, let us look at what these required disclosures are as we proceed. Now, as you calculate the revenue percentage, 10% of the combined revenue of all the segments, you can also include intersegmental sales. What does it say? Now, right within the same entity are there couple of business operations A, B, C, D, so on and so forth, that continues up to I. So, how many segments are there? 3, 4, 5, 6, 7, 8, 9. So, there are 9 different business activities. It does not mean that there are different entities for each segment. No, right within the same entities, right under the same roof and the shade, different 9 business activities occur and take place. So, this is the same entity, same company, same institute, but there are different business activities happening. Now, sometimes there can be intersegmental sales, like A can sell goods to B and B can sell goods to A, and so on and so forth. There can be intersegmental transactions. In calculating the 10% revenue of the combined revenue of the segments, you can include intersegmental sales as well. Now, what I am saying is this: the total sales of segment A is 9,000, maybe it is including 4,000 worth of sales done to the next immediate segment of B. Now, let us look at it not from the entity's viewpoint, we will look at it from the individual segments viewpoint. And now, the total revenue is 9,000, which is including intersegmental sales of 4,000. So, that does not matter of you including intersegmental sales into the sales of each segments in calculating the 10% revenue of the combined total revenue. You need not to remove it, just let it to be included. But there is another issue. Let me explain that issue, what it is, with a small illustration. So, this part must be clear now, and there is another small requirement of revenue. Let us see what it is. Let me go through that paragraph and then let me explain. it says at least 75% of the entity's external revenue must be included in reportable segments. Other segments should be identified as reportable segments until 75% of external revenue is reported. Information about other business activities and operating segments that are not reportable segments are combined into an all other segments category. Information about other business activities and operating segments that are not reportable segments are combined into an all other segments category. Now, 75% rigmarole I need to explain, that is where most of you all get stuck. Even after explaining, sometimes you do not get it right and then still you will get stuck there. So, let me explain that part gradually. Say we have identified couple of segments, say A, B, C, D, E, F, and let me take the revenue figures here. Revenue figures: A 50,000, B 60,000, C 40,000, D 45,000, E 25,000, F 20,000, and all these segments, operating segments, have already become reportable segments by satisfying some quantitative threshold or other. Now, as I said before, the segment that became a reportable segment can have revenue which includes intersegmental revenue as well. So, what is the revenue of segment A? 50,000. Included in this 50,000 revenue of segment A is a revenue of 30,000 which is intersegmental. Out of 50,000, 30,000 revenue has been generated by selling goods and providing services to the other segments within the same company. Now, what is the total external revenue reported in segment A? It is only just 20,000. This is external and this is internal. I made a mistake. This is internal and this is external. So, once again, B, included in this 60,000 total revenue is an internal revenue of 40,000 and the external revenue is only just 20,000 once again. Out of 40,000 total revenue of C, 30,000 has been internal to the other segment. There would have been some other segments which have not been recognized into reportable segment because it has not satisfied any of the quantitative threshold. Out of 40,000, 30,000 is internal, so the balance 10 is only the external revenue. And included in this 45,000 total revenue of segment D, nothing is included, nothing, there is no external revenue, everything is internal revenue. Entire 45,000 has been internal, so external part has been 0. Then E, out of 25,000, 15,000 has been internal, only the balance 10 has been external. F, out of 20, nothing internal is included and the entire 20 has been external, right. Now, I want you to understand one important point. Now, we need to prepare the separate, we prepare the financial statements for the entity, and if you think of the revenue figure of the entity, the entity's revenue figure cannot include any of the internal revenue, that has to include only external revenue. Because now if A is selling goods to B, this is like the entity selling the goods to the entity itself. It is like me selling the goods to myself. If you look at it from the entity's perspective, entity's viewpoint, one segment within the entity selling the goods to another segment within the same entity is like the entity selling the goods to the entity itself. So, if you count the total revenue figure of the entity, that has to include only the external revenue and it cannot include any of the internal revenue. Now, the external revenue which the entity has reported is 500,000 rupees, and let me reduce it down to 300,000 rupees. Total external revenue 300,000. Out of this, can I further reduce it down to 100,000 please? 100,000 external revenue of the entity. Entity's external revenue is 100,000. Of this 100,000 external revenue, how much of the entity's external revenue of 100,000 is reported in this identified reportable segments? A has 20,000, B has 20,000, C has 10,000, E has 10,000, F has 20,000. Total, this is 30, this is 40, this is 60 and this is 80, and let me do a small change please. Total revenue of the entity external 200,000. Now 80,000 of 200,000 external revenue is reported in these identified reportable segments. So, what does the standard say? At least 75% of the entity's external revenue must be included in reportable segments. The entity's entire external revenue is 200,000, out of which 80,000 is recorded in the identified reportable segments. 20 is recorded in A, 20 is recorded in B, 10 is recorded in C, nothing is recorded in D, 10 is recorded in E, 20 is recorded in F. Out of 200,000 total external revenue of the entity, 80,000 worth of external revenue is now recorded in this identified reportable segment. As a percentage, it is going to be what percentage? Now, it is going to be just 40%. It is 40%. That 40% is not the recommended percentage. What is the recommended percentage? 75%. At least 75% of the external revenue of the entity should be recorded, should be recorded in the revenue of the identified reportable segments. So, you need to continue, you need to go on picking reportable segments of the remaining segments, remaining operating segments. You need to go on picking reportable segments from the remaining operating segments until this 75% of revenue requirement is satisfied. Now, there can be some other operating segments which have not become reportable segments like G, H, I, J, K, L, M, N and so on and so forth. There can be remaining operating segments that did not satisfy any of the quantitative threshold. Now, you need to go on identifying, you need to go on picking the remaining operating segments into reportable segment until such time 75% of external revenue requirement is satisfied. So, that is what the standard says, right. Then, let us look at the aggregation criteria. SLFRS 8 says that two or more operating segments can be aggregated and reported as a single operating segment, provided that they have similar economic characteristics and are similar in the following respects: products and services, production processes, classes of customer, distribution methods. Now, let me take the last one and to explain that. Say, an entity can have multiple number of operating segments, it can be 100 segments in numbers. And if the entire 100 segments do become reportable segments, your financial statements can be the longest ever in the world. You know, sometimes some stakeholders in the financial statements are not bothered to read each and every single item and figures in your financial statements. Why? It's too lengthy. Reading that will be so hectic and people can't afford to lose time to read everything. So, you need to make it understandable, you need to make it concise. Now, without you making the financial statement so lengthy, some of the segments which have similar characteristics can be combined together. The birds of the same feather flock together. So, likewise, the segments which have the similar economic characteristics can be combined together. So, how do we combine? What should be the aggregation criteria? What should be the criteria to be used for these combinations, for this merge? Now, sometimes some business activities which are looking alike may be segregated based on the distribution methods, or sometimes two distinct business activities can be combined together depending on the distribution methods. Now, let me take a simple example. We will think of you and I, we will think of ourselves. Now, during this pandemic situations, we had to shift from physical classes to online mode, and that is what we are experiencing now. Now, we are conducting when everything is becoming normal, when the world is getting back to its normalcy, we started and we resumed our physical classes as well. Now, we have two distribution methods, physical mode and online mode. So, some people prefer physical classes, some people prefer online mode, two distribution channels. Now, if the entire population is 1000 for the subject, financial reporting subject CL2, out of 1000, 600 prefer physical classes and 400 prefers online mode. And then, though we deliver the same stuff and the same subject, the same example, the same voice and the same personality, same illustration, some people prefer one particular distribution method and another segment of the market prefers online, and some segment of the same market prefers physical. And isn't that an important fact of information to the readers, because your margins depending on the distribution can be different. Your cost depending on the distribution method can be different, and your revenue depending on the distribution method can be different. Then the stakeholders of the financial statements can take various decisions depending on this segmented information, how the profit has been varying depending on the distribution method. That is one particular way. Then classes of customer. Say we are selling motor vehicles. And we are selling vehicles to two category of customers. First category, professionals like you all, chartered accountants, doctors, engineers, lawyers and so on and so forth. And to non-professionals. and you can identify the revenue generated from one particular segment of the market, and you can make a comparison. So, you can make a contrast between the revenue from one particular segments with the other segment of the market, and you can compare, you can contrast the margins, you can contrast, you can compare the cost, classes of customer. Production processes. Production processes, say we have two products, say we manufacture petrol and also we manufacture say diesel, two products together, I mean ultimately end of the day two products. But if you look at the production processes, these two production processes have a lot of things in common. So, without you reporting them separately, without you having separate two segments for petrol manufacturing and diesel manufacturing, might as well to combine these two together and to report it as one segment altogether. Products and services, due to the nature of the products, nature of the similarities of the services, you can combine those products and services and to report them as a combined segment without them being reported about separately. Then let us look at the disclosure requirements. I have given you some profusely explained illustrations of how to identify reportable segments. You can work it out on your own. Let us look at the disclosure requirements. I have given you a specimen of disclosure requirements to you all. Let us have a quick look at it. Revenue from external customers should be disclosed, revenues from intersegment transactions should be disclosed, interest income should be disclosed, interest expense should be disclosed, depreciations and amortization should be disclosed, exceptional cost should be disclosed, segmental profit has to be disclosed, impairment of assets need to be disclosed, additions to non-current assets need to be disclosed, segmental liabilities need to be disclosed. Those are the requirements, disclosure requirements of segmental reporting, and that is so much. It is so much for SLFRS 8, and we have discussed almost everything. And thanks for watching our videos of SLFRS 8, and we will meet up again with another video.